Hospitality Investment Trust filed for bankruptcy in the year 2021. This is another REIT, Pennsylvania Real Estate Investment Trust, filed for its second bankruptcy in 2023. Another potential risk is that the REIT's share price going down instead of going up over the long term. For example, Diversified Healthcare Trust, you can see that its share price peaked in around 2013. After that, it has been going down for the next 10 years. How you can avoid picking the worst kind of REITs. So REITs stands for Real Estate Investment Trust. Real Estate Investment Trust is a company that takes investors' money and then buys and manages real estate for them. It makes money by collecting rent, and it also makes money when it sells its property for a profit. When it comes to investing, I believe that you should always think about the potential risks first and not think about how much money you could potentially make first. Because once you have prepared for all the possible outcomes, especially the worst scenario, you won't be caught by surprise or even panic when the market moves against you. Believe me, it definitely will at some point in time. So how do you avoid picking REITs that could potentially lose you money? By studying REITs that have performed very poorly, we found that the worst performing REITs tend to have the following characteristics in common. Firstly, the funds from operations are either staying flat or declining. On the other hand, high quality REITs are able to grow the funds from operations as well as increasing the dividends consistently over time. So what is funds from operations? Funds from operations is a common metric that analysts look at when analyzing REITs. Basically, it tells you whether this REIT is making money or not and how much it is making. So to be profitable, the rent that is collecting should be more than cover all its expenses such as property expenses and interest expenses. Now let's look at example, Pennsylvania Real Estate Investment Trust. We click on financials, then go to income statement, then scroll all the way down to find funds from operations. As you can see that its funds from operations has been declining since 2016, and it went negative in 2020, and in 2022 is also negative. Negative funds from operations is not financially sustainable. So this is the share price chart of Pennsylvania Real Estate Investment Trust, and as you can see that it dropped from the high. Its peak is at almost 700 per share, and it dropped all the way to zero, almost zero. Let's look at another example, this Ashford Hospitality Trust. Let's go to these financials and income statement. Let's go down to find funds from operations. As you can see that its funds from operations has been declining since 2015, and it went negative in 2020, and it's negative again in 2021, and it was briefly positive in 2022, but then it went negative again in 2023. So this is the share price chart of Ashford Hospitality Trust, and as you can see that the share price has been dropping since 2015, all the way from almost close to 1,000 per share all the way to $1 per share. So this is the kind of scenario that you would want to avoid. So another danger sign that you should look out for before investing in REITs is that you should find out whether this REIT has very high debt. So how do you tell whether its debt is too high? So one way is by looking at its gearing ratio. So a gearing ratio is calculated by dividing total debt by its total assets. As a general rule, a gearing ratio of 50 or higher is considered risky. A gearing ratio of 30% or less is considered safe. Another way to assess whether a REIT's debt is too high is to look at funds from operations to interest expense ratio. This is a financial ratio that measures a company's ability to pay interest on its outstanding debt. Again, the higher the ratio is, the better its financial situation is. So let's look at analogy. So let's say Ryan's monthly income is $5,000 and his monthly expenses, including mortgage, car expenses, utility, and other living expenses, is $8,000. So do you think he's doing well financially, or do you think he has too much debt? So this is the same for real estate investment trust. So another thing that you should take note of is high interest rate. As we know that real estate investment trusts take on a lot of debt to purchase properties. So any changes in interest rates will impact rates performance in a big way. For example, when the Federal Reserve started to raise interest rates from near zero to more than 5%, REITs as an investment class did very badly. In fact, many REITs crashed by more than 50%. This is because their interest expenses will go up when they refinance the debt at a much higher interest rate. Right now is early May of 2024, and for the past few months, REITs actually have been doing quite well. And this is likely because everyone is expecting the Federal Reserve to cut interest rates this year. So if the Federal Reserve didn't cut interest rates as expected, REITs could possibly see a pullback soon. Another danger sign is dividends getting cut or paused. So when this happens, it means the company is struggling financially. So this is what I use when I research on REITs and want to find out information on its dividends. Seeking Alpha Premium actually provides dividend grades on dividend safety, dividend growth, dividend yield, as well as dividend consistency. So the highest grade is A+, and the lowest is F-. So for all these four categories, ideally I would want to go for REITs with A+ for all these four categories and avoid REITs that with F- for any one of these four categories. And the most important one that I will look at is dividend safety and dividend consistency. So dividend safety actually refers to the company's ability to continue paying current dividend amount. So if it's a F-, that means that the company's ability to continue paying current dividend amount is very, very low. So it's likely to cut or pause its current dividend. Now let's move on. There are also other warning signs that you can look out for. For example, does the REIT have a very high vacancy rate? What about its tenant profile? Are its tenants able to pay rent on time? And what about the average lease expiry? So if the average lease expiry is very short, that means they will have to always look for new tenants if the existing tenants do not want to renew. And this adds more uncertainty to the business. Let me use an analogy to help you understand. So let's say you own a rental property, and if you have trouble renting out your property and your property is always vacant, do you think you are losing money or making money? And let's say if you find a tenant to rent your property, but your tenant fails to pay rent for a few months and eventually you have to evict your tenant, do you think your property make money or lose money? And lastly, if you rent out your property on a 1-year lease, and when the lease ends and your tenant doesn't want to renew, and you have to pay money to find a new tenant and also bear the risk of not being able to find a replacement in time. So when it comes to rates, it's similar. So you want a low vacancy rate, high quality tenants, and high average lease expiry. So this information is easily available in the annual reports. When it comes to investing in REITs, it's always better to go with REITs that are in good financial standing. So how do you find REITs with good financial standing? Just to recap, here is a list of metrics that you should look at. Is funds from operations? Is it growing over time? its gearing ratio, is it too high? And its occupancy rate, is it high? And its tenant profile, does it have high quality tenants? If you have any other topics that you want me to talk about, leave a comment below, and I hope that you enjoy this video.